Hey everybody, welcome to course number 3, Investors Relate course number 3. And in this course, we'll be basically just breaking down what stock options are. And stock options are basically, stock option actually gives an investor the right, but not the obligation to buy or sell a stock at an agreed upon price and date. There are two types of options. You got the puts, which is betting on the stock to fall, and you have the calls, which is betting on the stock price to rise. And with the calls and the puts, let's see. Let me show you here. So right now, let's clear this. So if you would click trade at the bottom of your screen, it's at the bottom, just hit trade there. And then you see where it says target. Let's just type something else so you can see if you want to type something else. Let's type Square. So let's say SQ. And Square, that's the payment processor. They actually own Cash App as well. So you can click Square. And then you'll click view option change. Make sure at the top you see where it says stocks and options. Make sure you click on options, and then you'll click view option chain. And under the option chain, you see the calls on the left side. If you look at the top, see where it says calls, and then on the right side, you see where it says puts. So you can play both sides. So unlike just buying a stock, if you were owning a share of a stock, you would only hope for it to go up, because when it goes down, you lose money. When you're trading options, you can actually play a put. You can buy a put, and if the stock price goes down, then the put starts to make money. And if you want the stock price to go up, you will buy a call, and as the stock price goes up, the call will make money. And just another thing just about options, and just to show you a little bit about this option chain here, if you click on that date where you see January 5th, 2020, you can just click in that white bar there, and you'll see how all of the other dates show up. And you can actually select expiration dates on options. So unlike just having a stock and you have it forever until you decide to sell it, with options they expire. So when you are buying options, calls, inputs, you want to think about like, okay, do I think this option will make it to this strike price by the expiration date? And if not, do I think it will move significantly where I can still make money even if it doesn't make it to that expiration price? And it's good when you're buying options, especially when you're beginning, it's good to give yourself time on expiration. Of course, if you look out, let me show you an example. So I'm going to hit June 12th here, which is this coming week. So if I hit June 12th, and you can see the prices there. So let's just look at the 89 strike. And the strike price is just the price in the middle. That's the price you're saying, okay, I think this stock will hit this price by this expiration date. So just say $89. And if you see at the top where you see Square SQ, to the right of there, you see it's already $89.90. So this is actually in the money. And on your screen, you'll see things in gray. On one side, on the call side, you'll see gray at the top. And on the put side, you'll see gray toward the bottom. And everything that's in gray, that means those contracts are in the money. So basically, if you're saying, okay, I think this stock will hit 89, it's already in the money. So as the stock goes up, if you have a call, then your money goes up. And you can always sell the call contract before it expires. And let's just look at, so we're basically comparing prices. So if you see next to 89, the 89 in the middle, look to the left on the call side. And under calls, you see bid, ask. So the farther left is the bid price, which is $285. We'll talk about bid and ask in the next class. And the next price to the right of the bid price is the ask price, which is $3. Both of these are to the left of the 89 strike in the middle. And actually, one contract equals 100 shares. So you see $285 and you see $3, but those will actually cost you $3 times 100. So that will cost you $385 if you get it for the ask, and $285 if you get it for the bid price. So you got to think about that as well, that these prices are times 100. And just for an example, like I said, the further out is safer, but it's also more expensive. So right now we're on June 12th. Let's go to July 17th, about 42 days out. Expiration is about 42 days out. Let's click on July 17th, and let's look at that same $89 call. Well, we actually don't see an $89 call for July 17th, so let's click July 10th. All right, there we go. So you see, we see an $89 call, and you see this call is $5.25, $6.35, and of course that's time 100. So you would actually pay $525 and $635 for this. And the reason it's higher is because the further out you go, the more likely that the stock has a chance to hit that price. So that means you pay more for the actual premium. And even that's the same, that works the same on the put side. So there's a lot of people play calls and are kind of scared to play puts, but it's the same thing. It's just on the opposite side. If you wanted the stock to go down, you'll play the put side. And if you want to go up, you'll play the call side. And like I say, the gray is in the money. The white prices are out of the money, which means they're not yet in the money, which means if something's out of the money, that means the stock price hasn't reached that price yet. And of course, on the call side, you can see 90 is out of the money. And on the put side, you see 89 is out of the money, because puts, you're betting on the stock to go down. So it hasn't went down to that price yet. So that's why that's considered being out of the money. So that's basically a breakdown of what stocks options are. And another thing about stock options, it's a way that you can make more money without putting a lot of money up. So in a regular scenario, if you had one share of Square, which is $89.91 right now at the moment, and it moved $10, then that means if it moves $10, that will be $99.91. So that means you'll make $10 off of that. With an option, if you had one contract of Square and it moves $10, then you could, double, or maybe even, you can double or maybe even triple your money. It just all depends on how much percentage that the stock moves. And it also depends on the delta and the theta. And we'll talk about delta and the theta in the upcoming classes. And we'll get deeper into actually stocks. But I just wanted to get you a basic understanding of what a stock is. And with the strike prices, if you see where it says strikes 10 there, you can actually change the strike prices. I mean, you can change the strike. So right here, we see from 87. See on June 10, you see 87 in the middle, and you go down to 92.50 at the bottom under the June 10th day. If you want to see more range, you can change the strike price to 24, or you can change it to all, so you can see all available strikes. And now you see the strike at 45 there, and you can see all the way to probably 100 and something, all the way to 135. And you see those calls get cheaper because they're so far out of the money. So if you look at the 135, you see over to the left of the 135, you can see that's 40. It's between 4 cents and 48 cents. So you could probably get that for a median price. So that's between a median price between $4 and $48. And you can just basically calculate a median price by saying, 48 minus 4 is 44, and you divide that by 2, and that'll be 22. And you add 22 plus the 4 cents. So about 26 cents, you can actually get that. That's about the median price between $4 and $48, or 4 cents and 48 cents. So, yeah, this is just basically a breakdown on what options are. And we'll talk more about options, because this is what the courses are about. So we'll talk more about options and actually purchasing positions, closing, opening, all of that good stuff in the up and coming class. Thank you, and have a good day.